This mining stock education lecture is going to cover maintenance capital or maintenance Capex or capital expenditures or Capex. So maintenance capital expenditures or maintenance Capex. And in my opinion, this is not covered nearly enough by mining stock analysts, gold stock newsletters. They don't talk about it. They only look at the upside of a mining company and the upside, the rewards of a new mine. And really, they don't talk about the downside or the risks nearly enough. In my mining stock education lecture series, I did an entire show on how to manage your risk versus reward, understanding the downside. And this is why I don't own a lot of mining stocks, because I know how the industry works. And there's always the opportunity. I wouldn't say the opportunity. Let me rephrase that. There's always the risk that even though a mining company is going really, really good, that 6 months, a year, 2 years from now, things can drastically change. We know this from the past, in the recent past, in the last couple of years with Goldcorp. That was symbol GG, Greg. Things were going very, very well for Goldcorp until they tried to bring online too many new mines, too much growth, and they ran into problems building a new mine, problems maintaining mines. And mining is a very cyclical, because commodity prices can fluctuate a lot, very capital intensive business, which means that margins are not going to be anywhere near the levels of a Franco-Nevada or a Sandstorm Gold. The average gold mining company is not going to have higher than 80% gross margins. In Franco-Nevada's case, higher than 90% gross margins. They're not going to have net profit margins consistently above 20%. Sandstorm Gold, on their Q3 2019 earnings that were just released last week, they had 24% net profit margins, $6 million in net profit, $25 million in revenues. Okay, the average mining company is not going to have that. However, for Agnico Eagle Mining, AEM, so Alice, Elaine, Mike, that stock 2 weeks ago announced earnings, and it jumped a lot. Dividends increased 40%. They started to generate free cash flow again, although I'll talk about it in a short amount of time. I don't think their costs, they're claiming that they have a $600 per ounce free cash flow margin, that their costs are around $900 an ounce. I looked through their SEC filings on their website and on the SEC to see if there was any discrepancies, and it looks to me like I was running the numbers and they should have, let's see here, they have 477,000 ounces of gold production approximately for this past quarter. They claim to have $600 per ounce in free cash flow margin when their costs are around $900 an ounce and the gold price was $1,500. The spot gold price was $1,500. That means they should have $600 an ounce in free cash flow margin. So if you multiplied the 477,000 ounces of gold production by the free cash flow margin number, the 600, they should have generated, according to my calculations, approximately $286 million and $286.2 million in free cash flow for the quarter. And I looked at their operating cash flow statements and there was nothing near that. Now, they did have free cash flow, but the free cash flow looks like the number that I'm looking at was closer to, okay, it's in the PDF that I have here. PDF was closer to around 100. Net increase in cash flow for the quarter during the period was around 140 million. So the numbers I ran, it should have been 286 if their costs were correct. The all-in sustaining cost number they were reporting was correct versus 140. So less than half. So that means their real costs are probably closer to like $1,200 an ounce. So they have about a $300 or $400 per ounce cash flow margin. I haven't run the exact numbers. So the business is doing well. The stock price is up significantly since January. The stock was at $39 per share in January of 2019. It's up to a little under 60 now. It's at 59, I think, the last time I looked at Agnico Eagle. So it is, according to one article on Seeking Alpha, the most highly valued gold miner on different valuation metrics. They did increase their dividend 40%. They have gone from barely treading water. Their cash flow, I think let me look at this here. Their Q3 earnings estimates jumped fourfold from the year ago. More than fourfold. So their Q3 earnings from a year ago, year over year, jumped more than fourfold. So it's impressive. The business is in much better shape. However, This is why mining is a lot more difficult than a royalty and streaming company. The royalty and streaming company does not have to deal with maintenance capex. Okay, so if Agnico Eagle 6 months, a year, 2 years from now, this is just my opinion, not financial advice. This is why I don't own a lot of individual mining company shares. So 6 months, a year, 2 years from now, Agnico Eagle, they could have a problem with one of their mines. If you go and look at how much money they're spending on some of their mines, and they have quite a number of mines online now, and a couple of their mines are up and running in commercial production, the investment for some of the mines could go from 20 million or 50 million per year. All of a sudden, there could be a problem at one of the mines, like what Goldcorp had with a few years ago with Penasquito, where the costs started going like crazy, or what happened with New Gold when New Gold was trying to bring on Rainy River. New Gold, that almost bankrupted the company. So New Gold was a very well-respected, very well-run miner until Rainy River. They overpaid for Rainy River, and in the cost to build Rainy River, it was not on time and on budget, and they had a lot of write-offs. There was an enormous amount of delays. It was nowhere near the cost. They wrote off in a single quarter, New Gold did, over $280 million in write-offs. Over $280 million. So, things can change. My point, things can change very, very quickly at a mining company, especially ones that are trying to appease Wall Street. Wall Street doesn't care a lot about the balance sheet. They care more about the income statement. But if you look at the income statement of a successful gold miner like Agnico Eagle versus the income statement of Franco-Nevada, and you look at their margins, you compare gross margins, you compare operating margins, you compare net profit margins, it's going to be very, very different businesses. So for those of you who don't know what Capex is, just going to talk about some definitions really quick. So there are generally two reasons companies spend money on capital expenditures or Capex. One is to grow the business. That is growth Capex. That is an investment. The other is to maintain the business, for the assets. So if it's property, plant, and equipment, capital intensive businesses like mining, oil and gas, large factories, large factories as in like Ford, General Motors, Tesla. Ford has to, if you're not familiar with the auto business and why the auto business is very difficult and very expensive, number one, you have labor, always the unions and labor always demanding higher pay. So if they take a pay cut or they don't renegotiate higher pay, they're going to try to go back, and look what happened to GM 6 months ago. How at the worst time when sales were starting to fall, the United Auto Workers were demanding higher wages. But for those of you who are not familiar with the auto business, every couple years, the factory has to be retooled. That is very, very expensive. We're up into the cost now. I think for Ford and GM, some of their factories cost, hundreds of millions, if not over $1 billion, to retool the factory every few years. And for mining companies, every year there has to be a base level of maintenance capex to keep the assets, the property, plant, and equipment, to keep the assets generating revenues, generating positive cash flow, hopefully, if commodity prices. And some of those years, if there's a flood, there's so many things that can go wrong in a mine. I don't have time to list them all, but there's flooding, there's labor problems, there's governments increasing royalties, there's equipment breaking down, there's in Mexico there could be security issues, there's tons and tons of problems. In Brazil there's illegal local miners around a lot of the areas in Brazil. So there's tons and tons of problems at a mining company because it's a fixed asset. You can't move the mine. You can't, if the government tries to tax it more, you can't pick up and move the mine. It has to stay there to generate revenues and cash flow and profits for the business. And this is why what South Africa is doing with talking about nationalizing the mines and increasing taxes on the mines or some type of plan like that. That's why it's dangerous, because the mining companies are not going to invest at all then into South African mining at all. The investment's going to dry up. So maintenance capex is to capital expenditures or maintenance capex is to maintain the business. It's to keep the property, plant, and equipment at the mine or at a factory if it's not mining. It's to keep it running so you can generate those revenues. The problem with mining is that even if commodity prices fall, the miners can temporarily cut costs, but still there's big maintenance capex that is needed to it's a large cost just to keep the mine running. So even if you shut down the mine, there's still, care and maintenance. That's still pretty expensive to put the mine onto care and maintenance, so the mine is ready to restart. So some of these maintenance capex expenditures, if it's a large company like Agnico Eagle and they have more than 6 fairly large gold mines running. You're looking at some years between $20 and $50 million per mine if the mine doesn't have big expenses just to maintain the current production levels of the mine. If there's a sudden accident or problems at the mine, or there needs to be an investment to, let's say the grade drops at the mine, and they have to bring in extra equipment to increase the gold recovery or the silver recovery or the copper recovery or some combination of those things. They have to rerun it through the they maybe have to rerun the ore through. They run recycle ore through occasionally. That's a new technique now to enhance recoveries. So all these things, all these expenses add up, and mining companies can get in trouble, like Goldcorp in the past, and like New Gold with Rainy River bringing a mine. There's a lot of problems that can go on with a mine. The pre-feasibility study could be way off. The feasibility study then comes out, and the costs are very, very different. There's so many problems with that. For the mine to come in on time and on budget, most mines don't come in on time and on budget. It's below 50% of mines coming in on time and on budget. Sometimes the cost discrepancy between a pre-feasibility study and a feasibility study is enormous. Sometimes I've seen them where it's over 50% cost discrepancy. Not every single one. And then you get into a situation not only with that, but New Gold and Goldcorp, Rainy River, and some of the other mining companies out there. There's a ton of them that have run into problems. Hecla is another, where they think they're doing an acquisition, and on paper it looks like it's going to work, and then all of a sudden Hecla gets hit with all these extra costs to lower the cost. They have to put in all these extra expenses to lower the production cost of the mine to get it producing positive cash flow and making it profitable. Initially, Hecla, I think after that acquisition of the gold mine in Nevada, I think they were producing gold at $3,000 an ounce. I think it's been coming down, but still that's very, very risky. They're throwing lots and lots of capital at that mine, and the expenses can go, like New Gold with Rainy River, the expenses can get into the hundreds of millions of dollars per quarter very, very quickly, depending upon the size of the mine. And then the other example I was thinking of was Yamana Gold. I've talked about this at length, where Yamana Gold, to help extend the mine life of their best producing asset, which was Chapada, this long life copper and gold mine, they wanted to make an investment in 2 or 3 years into the mine of another couple $100 million. It was like $230 million were the cost estimates to make these upgrades, and that was growth capex. There was some maintenance capex, but also growth capex to improve recoveries and other things. And they had a bad balance sheet, because the mining industry has been in a bear market. They couldn't raise a lot of capital. They didn't have the $230 million. And so they sold their best asset with the best margins. They sold it to Lundin Mining. If you're a royalty and streaming company shareholder, you don't have to worry about all of a sudden you're holding an individual mining company stock, and then an unexpected large capex bill that you weren't expecting of $100 million, $200 million, $300 million comes out of nowhere 6 months or a year from now. You don't have to worry about that. So that's the risk. That's some of the biggest risks, maintenance capex. And I don't hear any really mining stock analysts talk about this. They really only talk about the rewards. They don't talk about the downside and risk. And at this point, people ask me, like, why don't you own a lot more stocks in different companies? Why don't you own a lot more mining shares since you know so much? I'm more concerned about playing defense right now than playing a lot of offense and being aggressive and picking out a lot of companies. I'm more concerned about defensive measures and having cash and having physical gold and silver, cash for opportunities, because there's not a lot of businesses like Sandstorm Gold that have low or reasonable need for capital expenditure and a high profit margin. So the high profit margin, if you look at an income statement and you learn how to do profit margins for gross profit margin, operating margin, net profit margin, you can compare these businesses one to another on the income statements and look at the margins. There are not a lot of businesses that have the margins that Franco-Nevada does, that have the amount of revenue per employee. Okay, mining companies don't normally have those. Now, if gold is ripping higher and the oil price is not also going higher, mining companies for a short amount of time in the right part of the cycle, they can have good margins for a while. But then the mining company CEOs normally, unfortunately, the mining company CEOs, and I think they're the worst of the bunch, the worst CEOs of any industry, you know what's going to happen as soon as gold goes over $2,000 an ounce. at some point in the future. And the Agnico Eagle CEO says that he expects gold prices to go to 2,000 in 2 or 3 years. I think it's reasonable, considering that the gold price in US dollars is the only gold price that's not at or near all-time highs in any currency. So we could see, because the Federal Reserve is already doing a bunch of stuff, both political parties don't want to cut government spending. There's a lot of increased debt monetization coming from the Federal Reserve with a bunch of not QE. Jim Bianco says it's hundreds of billions of dollars. But at some point, the mining company CEOs are going to do bad deal, bad deal, bad deal, massive dilution, bad deal. They're not doing, the mining company CEOs are not doing them right now, but when the cycle turns, they will. The mining company CEOs prefer to do bad deals at the top of the market. So I have a number of articles here about how to differentiate growth CapEx from maintenance CapEx. Growth CapEx is investments. Maintenance CapEx is costs. So not enough analysts talk about maintenance CapEx. And maintenance CapEx is important because mining companies normally have a lot of it. Even in years where they don't have to make $100 million or more upgrades into a mine, it's still 20 million or 50 million if it's a fairly large mine per year. So if a mining company owns a lot of mines, if they own 6, 7, 8 mines at 50 million per year, that starts to add up. That eats into free cash flow. All those extra costs. And in my opinion, if you want to look at a long-term business, the key to a successful long-term business is the margins. So the gross margin, the net profit margin, if you can find a business that has gross margins that are way above 60 or 70%, there's not a lot of them that have routine gross margins that high. And the net profit margins that are in double digits, normally over 15 or over 20%. Those are very rare. So a high profit margin, high turnover business. The book Buffettology talks about this. But value investors like Seth Klarman, he wrote Margin of Safety. That book is out of publish. You can get the ebook. You can search on the internet and read it, Margin of Safety. It's considered one of the value investors' Bibles besides the Benjamin Graham books of intelligent investor and securities analysis. And Margin of Safety talks about maintenance CapEx, maintenance capital expenditures, if the business is generating free cash flow a lot. And the mining companies struggle to generate consistent free cash flow in a lot of ways, not only because their revenues are fluctuating and they've loaded the balance sheets with debt, but also because of how much costs they have to maintain property, plant, and equipment maintenance CapEx. So maintenance CapEx is not an investment. Growth CapEx is an investment. So if the miner makes an investment to increase production at a mine, that's growth CapEx. Or to extend the mine life with exploration drilling, that's growth CapEx. Sandstorm Gold has $1,200 an ounce margins with no maintenance CapEx. So Agnico Eagle is claiming $600 an ounce margins, and I told you that their free cash flow numbers don't match. The free cash flow projections on their ounces of gold produced for the quarter don't match what their free cash flow margins are, the total number. Sandstorm Gold doesn't have to worry about the cost rising at a specific mine. Sandstorm Gold this past quarter, this is why the business model is so good. Their costs are protected. They're insulated from a lot of this. They had $1,200 an ounce margins at the current gold price. Franco-Nevada has an enormous amount of revenue per employee. I think Franco-Nevada has 40 employees and over $10 million per employee. It's an enormously efficient business. Superb margins, very capital efficient. They can focus on investing in growth, whereas mining companies, if there's a correction in the gold and silver price, or gold stays flat or gold goes down, the mining companies are worrying again. So I have 4 articles here about maintenance CapEx, free cash flow, understanding it. how to look at the operating cash flow statement, the statement of cash flows with the operating cash flow area, and then subtract maintenance capex and figure out how much free cash flow a company is generating. It's really tough though for the miners to maintain margins because their input costs, the metals prices can change, and the input costs can also change very wildly. Like the cost of those large truck tires there in the picture, the cost of those things when gold was going to 1900, the cost of those truck tires there on your screen went from, I believe, $5,000 per tire, which is still a lot of money, but I think they went up to $40,000 per tire. And the mining companies, if it's a large mining company, if it's a large open pit, those trucks are running 24/7, 365, and they're burning through those tires and diesel fuel very, very quickly. There's a day crew and a night crew at a lot of these mines. Those tires prices, they've come down, but at one point those tire prices went from like $5,000 per giant truck tire, they went up to $40,000. I don't know what the tire prices are now. My buddy Steve San Angelo was covering this. So that just goes to show you that the costs of mining, they can fluctuate very, very rapidly. And that makes it difficult to maintain, for the business to maintain margins and for the business to generate free cash flow. So, just my opinion, Agnico Eagle is in a good spot right now. 6 months, a year, 2 years from now, the management team could make a mistake. There could be a bad acquisition. The costs at one of their mines, there could be a big Capex bill of $100 million, $200 million, $300 million that could come out of nowhere. And all the free cash flow that they have now, it could dry up very, very quickly. This is what's happened to Goldcorp. Hecla did a bad acquisition. A number of bad acquisitions. Yamana Gold loaded too much debt on their balance sheet. So things can change with a mining company very, very quickly. And it's very, very dangerous. Again, just my opinion. It's very, very dangerous to buy and hold an individual mining company. If you buy a mining company in 2, 3, 4, 5 years from now, you think you're good. The mining company, the management team could have made a big, big mistake. They could have guessed wrong on the gold price. They could have screwed up an acquisition. They could have overpaid. The mine that they bought could have had disasters like Rainy River, where hundreds of millions of dollars were written off in a very short amount of time. And New Gold almost went bankrupt. New Gold went from very well-respected mining company. I made, I think, 5-fold gains on my speculation in New Gold in like 2 years before I sold those shares. And within another 2 or 3 years, they did the Rainy River acquisition, and the mine did not come in on time and on budget. There were an enormous amount of problems. It was super capital intensive, and the company almost went bankrupt. And they still have balance sheet problems. Now, I got out before the stock crashed. I took my gains off the table. But the average person might not have been paying attention, or the newsletter writer might not have been, who was recommending that stock, might not have been paying attention. So, maintenance capex, in my opinion, if you read regular value investing books, very, very important. Maintenance capex is what raises costs in a business. For like a business that has to retool a factory, has a lot of property, plant, and equipment to maintain, like a mine or an oil gas company. And mining companies and oil and gas companies, the commodity prices can fluctuate. So that also hurts margins. It hurts revenues. It hurts operating cash flow, the ability to consistently generate free cash flow. And some of those costs, the bills have to be paid for those upgrades or maintenance bills. They can be delayed a little bit, but ultimately they have to be paid at some point, and that's why Yamana Gold sold Chapada, because they couldn't afford that Capex bill that was coming due soon. So that's why it's dangerous. I've done a number of these lectures for my mining stock education lecture series. That's why it's dangerous to buy and hold a mining company, an individual mining company, for a long period of time. Because there's so many things that can go wrong at the mine, lots of things, and the management team could screw things up with a bad acquisition, They could increase the dividend at the wrong time and start to take away the company's cash. If metals prices go down, the mining companies, after 2 good quarters, the mining companies are going to be in trouble again, probably. I'm not saying metals prices are going to go down, but I'm thinking about the downside here. I still think gold prices, based on what the Fed's doing, will probably end up at $1,600 by the end of the year. Gold is really fighting to stay above $1,500. There are a lot of people who, in the mainstream financial media, professional money managers who are not gold bugs. People who go on macro voices who normally don't like gold, and they're saying they're buying gold now. There was another couple of them in the last week or two on macro voices on the podcast who were not bullish gold, who were never bullish gold in the past. I used to listen to interviews that they did, and now they're starting to buy gold for themselves and recommend it to their clients. Kirkland Lake Gold I did an entire show on Kirkland Lake Gold. They have the Fosterville mine. That might be the best, most economic gold mine right now. Now, the Australian government has put another royalty on there, that local province, but that is still the most economic gold mine right now. Fosterville is the best mine, but 5 years, 10 years from now, we don't know if the grades are going to fall. So for now, Fosterville is really, really good. It's as good as it gets. Although I think the Hod Maden mine in Turkey will give it a run for the money once that mine is built and online, generating cash flow. The economics and grade and the other geology there at that mine, it's very, very high grade copper and gold. That might be right up there with Fosterville. Okay, let me look at the super chats. Thank you, Tarkinas, and thank you, Dimitri, for the super chats. And thank you very much to my over 180 Patreon account contributors. Hopefully, I will have 200 in the next couple months. It'd be nice if I have over 200 by the end of the year, so I don't have to worry about the stupid games that YouTube plays with me. When do I think GDX will rise? In my opinion, the miners are having 2 good quarters, but their balance sheets are still a mess because they've had a bear market for 7 or 8 years, and the management teams at many of these mining companies have made a lot of mistakes. So 2 good quarters does not make up, 2 good quarters of improved margins and improved cash flows does not make up for a 7 or 8 year bear market. From what I've heard with my contacts with Nolan Watson and others, first of all, the reason I talk about Nolan Watson a lot is because the royalty, if you want to learn about the gold and silver mining industry, the royalty and streaming companies, their presentations at the Denver Gold Forum, they see all these deals. So if the mining companies need money now, the investment banks, the Canadian investment banks, a lot of them have shut down a lot, or either they've shut down completely their mining divisions or drastically reduce them, downsize them in size. And a lot of these smaller and medium-sized merchant investment banks in Canada have also shut down. So the ability for mining companies to do a lot of equity bought deals, especially over $100 million in size in the past many years ago when gold was going up, they could do a lot of these no problem. They can't really do any of these anymore. So for now, the miners, even if they have better margins, there's a lot of people that do not believe that the gold price is going to rally, even though the central banks are doing lots of crazy stuff right now. Just unbelievably crazy stuff, all the central banks. China, the US, European Union, Bank of Japan, all just crazier and crazier stuff. And yet there's a lot of mainstream professional money managers who do not believe in gold and do not think that the gold price will rise. And so they are not participating in any fundraising. The money is still going into the gold mining ETFs. So the gold mining ETFs will probably do well. If you do not want to pay for a good newsletter writer or learn to do the research on your own from individual mining stocks, I don't spend a lot of time going through all these individual mining stocks because no one wants to pay my fees to do the research. But the mining stock ETFs will reduce the risk of you getting killed. So your upside will be less than picking out the handful of good mining stock companies that actually can outperform, but your downside is way more protected. You reduce a lot of the risk, in my opinion, by owning one of the gold mining stock ETFs. There's the royalty and streaming company one, that's GoAU, Frank Holmes one. So that one has the royalty and streaming companies in there, like Franco-Nevada and Royal Gold and Wheaton Precious Metals and Sandstorm. Those are in there. But right now, a lot of stocks are really overvalued. There is still good value in gold mining, but there's a lot of risks. Because the industry just has had bad balance sheets for so long. And there's so many things that can go wrong in each mine. I used to subscribe to a lot of these mining stock newsletters, and none of these newsletters would ever talk about maintenance capex. Trust me, they don't talk about it at all. But if you go through the management discussion and analysis, you look at the annual reports or the quarterly reports, the management teams talk about things in there. But the newsletter writers who are covering the gold and silver companies, they don't talk about any of the downside. It's only normally, the reward, the upside, which is dangerous. If you want balanced coverage, you have to talk about the risk and the reward. Well, Franco-Nevada is actually safer than Sandstorm Gold. Sandstorm Gold just has more growth. Franco-Nevada is going to projected to grow operating cash flow to 50% increase in the next 5 years, which is still quite a bit for a large company. Franco-Nevada's market cap's, over 13 or 14 billion. So Franco is, even in this environment, even if the gold price stays flat or goes sideways or goes a little bit lower, Franco-Nevada is still going to grow their cash flows a lot in the next 5 years. Franco-Nevada is still a growth stock. Most people aren't aware of this. They're still a growth stock. It's just never cheap. It's the safest growth stock, but it's just never cheap. But if the management team executes and the operating cash flow, in my opinion, grows, if the management team executes properly, in my opinion, and the cash flow grows 50% in 5 years, you're looking at probably more than 50% return increase in the stock price in 5 years, if the management team executes that. Because if the underlying cash flow grows that much, the stock normally will go up, at least from studying a lot of stocks in the past, the stock will go up more than 50%. And Sandstorm Gold has a lot more than 50% growth. They're loading the pipeline with deals. I think they'll probably have another deal from what it sounded like on the conference call in 6 months or less. Sounds like there's a lot of good deals available on producing copper and base metal mines for gold and silver streams. Those miners want to sell a gold and silver stream for immediate cash flow. Dimitri asked on the super chat. Thank you, Dimitri, for the super chat. The mining indexes reduce a lot of your risk. So I like the royalty and streaming companies better. I think Franco-Nevada is safer than the mining stock indexes, but the mining stock indexes are safer than owning an individual mining stock. Because if one or two of the companies in the mining stock indexes have some problems with their mines, the index doesn't collapse. The index might still go up. So the index tends to protect you more. It caps your upside compared from owning individual mining companies, but also protects your downside more. But I've tried to, more than any other analyst, I've tried to explain all the risks involved in mining. Any of the other analysts in the gold industry. The risks in mining, there's tons of them. Tons and tons of them. And most of these newsletter writers don't cover any of them. And I've subscribed to these newsletters. I paid for them in the past. I'm friends with some of them. I've met them at conferences. I've gotten complimentary copies of some of them in the past. I was telling some of these guys in 2016 about Sandstorm Gold when it was below $3, and these guys were laughing like the business was bad. I was telling them about the margins and the cash flow growth. They didn't want to hear it. They were recommending other garbage. My money was where my mouth was. I about tripled my position in Sandstorm Gold in 2015 and 2016. I haven't sold any of my shares because I know what's going to happen. They're going to keep adding more deals, and the cash flow is going to keep growing. And then as more cash flow comes online, the valuation will keep going higher. The shares will keep getting re-rated. Why? Because this is exactly what happened with Franco-Nevada. Franco-Nevada only had, in 2009, a $2 billion market cap. Most people are not aware of this. Despite the gold price doing almost nothing, Franco-Nevada's market cap went up over sevenfold since 2009. And the gold price didn't do anything. Franco-Nevada still grew and grew and grew and added more and more cash flow, more and more diversification, dividend increases every year. I personally think, in my opinion, that Sandstorm should wait to pay dividend. They should be doing as many deals as possible for immediate or near-term cash flow. And then a couple years from now, once they have more cash flow in line, then they can start a dividend. But if the paper price manipulation keeps on going, if the open interest in gold means that the gold price or silver price is going to get smashed, so far it hasn't gotten smashed, but normally people in the past with the rapid increase in open interest, that tends to normally precede smashes. So far it hasn't. But that would benefit companies like Franco-Nevada, Royal Gold, Wheaton Precious Metals, Sandstorm Gold, if the gold price does get smashed again. Because the mining companies are still not out of the woods. They're in better shape, as evidenced by Agnico Eagle and some of the others. Things have improved. Agnico Eagle went from no free cash flow a year ago, and their earnings went up fourfold year over year. So Q3 2018, their earnings were their earnings have gone up fourfold in a year. And they went from no free cash flow now, last quarter I think, to free cash flow now. So things are getting better with Agnico Eagle. But if the gold price goes down or the oil price goes up, that could squeeze margins again. Okay, well, that's it for right now for this lecture. I want to thank everyone for listening to this. I do work hard. There will be a lot of articles in the information and description section. A lot of people don't read that, just like last night's live stream show. I had 4 articles in there from different sources, Caixin Global, Reuters, elsewhere, bullion dealers, and others, about the fake gold bar scandal that's emerging in China producing. No one wanted to talk about that. They all just call me fake news, which was ridiculous. Just a warning for you guys. If anyone says that, you're getting blocked immediately. So, my New Year's resolution, January 2019, anyone insults me like that, they don't even get a warning now. Okay, well, that's it for right now. I'm going to go enjoy the rest of my night and go get a workout in, go get some lifting in.